Hey folks, welcome to Pro Trader Strategies. We are an educational company, so please bear with me for a moment. We are here to give you guys an education, so if you want an edge, it's going to start right now. Before you go though, make sure you hit that subscribe button down there at the bottom. There's also a little bell that gives you a notification when I pop on unannounced, which I'm doing quite a bit lately. We do have scheduled times where I do a morning market commentary, if you will, and talk about spotting different trades. And then we do these webinars on Thursdays right after the close. Those are scheduled. You guys will know about those if you just put them on a calendar. But during earnings season, anything else, if I'm finding an option strategy that I want to implement at any given time throughout the day, I'm going to pop on and make sure you guys are aware of that. So before we really get started, we are talking about these swing trades using options. And further, we have talked about bullish moves, bearish moves. Now we're going to be talking about how you can make some money in a sideways market. Yes, you can do that with options. Yeah, we're talking about buying a stock based on a swing trade on a bullish or bearish move. Well, we want those moves to happen. Now, we think that this market is going to settle down and trade sideways. And I'm going to show you how you can take advantage of that type of scenario. And we've been seeing this in the equities for quite some time now with these different sector rotations. You don't know if the Nasdaq's up or down on a given day, or the bulls are going to be buying into the Dow or something. So we're seeing these rotations happen quite a bit, but we haven't really gone anywhere. So is it the time to put on a strategy for a sideways market? I think it is. And I think we'll show you guys some good opportunities as we go through here. But let's go through a couple of things real quick and talk about swing trades, right? We're going to be talking about the long call butterfly here eventually. But what I like to do is kind of follow our path to get there. It's not like every day you come in and say, hey, I got to put on a long call butterfly or an iron condor on any given day. No, what you do is you look at what's going on. You come up with a directional assumption. In this case, we're looking at a sideways move. And then we have to look at that underlying to see what is going to fit best for that underlying. Okay, so we aren't always going to be buying an option for a directional assumption, and we aren't always going to be selling an option for that directional assumption. We have to look at what's going on, and I'll show you how to do that here as we go along. But first, let's talk about a swing trade and what is a swing trade, right? That's a good question. A swing trade really is trying to read the tea leaves of what's going on in this underlying. So ultimately, the first step in trying to find no audio. Is anybody else not getting audio? Can you guys hear me? Can somebody Audio's good. Somebody else is saying they're hearing me. John David, you might need to turn it up a little bit. Some other folks are popping in here saying that they can hear me. All right. Okay. Audio's good now. I don't know if I touched anything, but it seems to be working all right now. Everybody's all good. Refresh your browser, Zeke says. John David, I guess if you can't hear me, there you go. All right. Thanks for commenting, you guys. I do need some help every now and again, and that came in perfectly. So what is a swing trade? Ultimately, what we need to do is see what the overall direction of this underlying is. And what we call that is the trend. So we're first going to try and spot what the trend is. And there's only three trends. You can either go bullish, market neutral, which is one we're going to be currently looking at, or a bearish directional trend. And in that trend, what we see is the underlying kind of does stuff like this, right? And we could see it trending sideways. And we're trying to find that pattern within the overall trend now. So this is the trend. The trend is overall what the long-term move is, all right? The long-term move is that overall trend, bearish on the overall trend here. Now, what we do is after we see that overall trend, we need to see where this underlying loses momentum to the upside or catches some support on that downside. And by doing that, you kind of blur your eyes and see where it's losing that momentum to the upside and capturing buyers. All right, losing momentum on the upside. And you can see that sometimes it will pierce through those support and resistances. That's nothing to fret about. Yeah, if you're trading the stock, you're going to be worried about that a little bit more than when you're trading with options, and I'll tell you why here in a little bit. But so now, so far, we've gotten the overall trend where there's bullish, market neutral, or bearish, right? And now we're looking at this overall underlying and see where it loses the momentum. That's where our support and resistances are. Now what we want to do and base our trade on is the pattern. So when the underlying is in a bullish trend and we found the support and resistance, this would be in a bear type pattern, looking like it wants to resume to the downside, right? As profit taking happens. And in this one, we've got a bearish with a bull pattern inside of that overall trend, right? A pattern is what we are setting our trades up in all of these strategies. But we do need to go through these other two steps, finding the overall trend, right? Because that's ultimately where we think that it's going to follow that trend. But the pattern is where we're going to set up our trade around, all right? So simple concept here. Now let's move on to some real life examples. And what we're doing here is we can see that this is a sideways trend or a market neutral trend, right? And then we kind of look at the underlying doing this, right? And almost looks like it's starting to roll over there. I want to erase a little bit so it doesn't cover it up too much. So let me try and do a little bit of eraser here. Hopefully it doesn't erase everything, and it does. So let's go back to the pen. All right, so we're looking at this, right? We can see it doing that. And right here, it looks to me like it's starting to roll over. We look at a pattern like that where you get a candle that we call like a hammer doji at the top of this move. That's what we're seeing right there. That is usually an indication that the market is losing the momentum to the upside, right? People are starting to sell up around this area that lines up with 132. And we've got a topping pattern there. If you are especially a newer trader, wait for a red candle like that the next day. That is confirmation of that top, all right? Especially if you're a newer trader, but this would be an opportunity for different entries, okay? And you can see on these different entries, they've blown through that little resistance area there on that Fibonacci. Maybe not blown through it, I shouldn't say, but have tested it, gone through and retraced back. Those are the opportunities, folks, because that's where you're starting to see that you saw it coming up against one of your resistance areas. Now you want to say, hey, that's going to start losing momentum. Now, if you were in the stock in a place like this, or even in a place like this, where you entered around those resistance areas, you might have gotten stopped out. But in this case, you know, when we were doing this as an example and selling calls and stuff like that, we are able to get a strike location that never got tested on these. So the idea here is using options is going to increase your probabilities of success. It will also help you keep out of the muddy water when you're trying to trade, especially in a swing trade. They don't always hit those supports perfectly and bounce off, all right? They pierce through them a little bit. And that's where most swing traders get knocked out, because their entry, their timing of their entry is imperative in order to be successful. Whereas when you're trading options, all we have to do really is make sure these levers and pulleys are working in our favor, and we don't have to be right and we can still make money. That's the beauty in trading options. That's why I love options, is because I can be wrong as long as I go through this mechanical process, set everything up, then I don't necessarily have to be beholden to my directional assumption, all right? So that's a big thing with trading. Follow through selling after the top. Yes, generally that's what we see when it comes up there. And listen, there's institutional traders, you know, you've heard them come out with their price targets for certain stocks, right? Well, they believe in those numbers that they're giving most of the time. But if that's true, when they come up to that 132, if they think that's expensive, that's of course where you're going to see a lot of that institutional trading. And when they say, hey, it's a buy around 115, then that's when those institutional traders are going to come in and support that market. Okay. So that's a sideways market. Here we could look at a bullish market, right? So we've got a bullish trend, overall bullish trend here. And then we can see that there is a resistance area. Got a little bit wanky. I might need to redraw these, but these are really old trend channels back to 2017, 2018, and we've just revisited those. So I like to leave those in there. But obviously when it comes down to the support levels, those are the opportunities to get involved, right? And then usually on these bull trends, coming back to about that mid area of the overall trend area that you've kind of drawn, that's for a newer trader where I would suggest to look to start to cover these trades. Get in when you've hit those extremes, get out when it comes back to the mid area, and then re-enter if it gets down to the extremes again, okay, for a reversal there. So this is what I was talking about when you want to make sure that next day you get that confirmation. And we've continued to see this underlying roll higher there throughout that after putting on a bullish trade on there. But what happens, sometimes you will think that you're getting set up in a perfect scenario where you got this hangman doji. Those are generally when I like to get involved. This is another one. This is more of a spinning top doji, but very similar in nature where you have a smaller base, a longer wick. And usually when the base is at the extreme highs or at the extreme lows of that wick, that's usually your telltale sign that the market bulls and bears are kind of butting heads here going forward. So when they're butting heads, that's when you're starting to look, okay, one of them's going to lose. And usually the candle gives you a heads up on that. But, it doesn't always work out. Here's our candle right there. That's why I suggest waiting for a confirmation. This did not get confirmed. All right. Immediately the next day, we did open up a little bit lower. The opening was right around here. Can you see that right there? That's the opening. So we did open lower. So immediately aggressive traders might have jumped onto that. But you want to be cautious being a new trader and wait for these confirmations. And you can see that that one didn't get confirmed on this. But having said that, entering in on these trades when it hit that has worked 3 times so far. And as a matter of fact, it would have worked on this one as well. We did not take that trade because of the earnings though. All right. So this really is an example of, making sure that you wait for the confirmation as a newer trader, because if the pattern is broken, then you're taking on a little bit more risk. Somebody that's maybe an options trader that's been around for a little while might enter this, like myself, without that earnings a little bit earlier. In general, the price action will be pulled towards the point of control as the buyers exhaust and the sellers dominate. Yes, that's absolutely right. So what Dave's talking about here is the point of control. And when we get to these extremes, you usually see the market want to revert back to the point of control. And I usually say it's kind of like a magnet, right? Where it's drawing it down. Because think about it, if most people transacted price at this level, right? That's where the acceptance of value is. That's where everybody feels that this is worth, okay? If most people are transacting at that, that's the assumption, is that's where its value is. But then when it gets to these extreme levels, think about it. If you were long and it's always been bouncing back and forth for the last 52 weeks, and all of a sudden you see a 137 trade, how much are you dying to sell 137s, right? Okay, nothing's changed in that time, but you'd be a little bit crazy not to sell that 52-week high. And most people are going to do that. That is where the buyers have been exhausted, because those guys start thinking, hey, I haven't seen 137 trading. They start selling, market starts correcting, and it reverts back to the point of control. Or in theory, it should. Now, if something happens like this earnings, they come out and they talk really well, and Now everybody expects more out of it. We could see price acceptance at higher levels. You see price acceptance at higher levels, then if you're short, you don't want to be in that kind of scenario. All right. So we want to use options. Why do we want to use options? I should say, as a hypothetical question, I guess. We want to use those options so we can increase our probabilities of success. But really quickly, a review on this, how to swing trade, identify that trend. Remember, that's the bull, market neutral, bearish. Then we want to identify that support and resistance area. Remember, that's where you kind of look for the underlying and look for something like that, right? And then ultimately you want to identify the pattern within that trend. So in this case, you could be looking at a bullish pattern within a bullish trend. It's not always a bullish pattern in a bullish trend that we're looking for. We are sometimes looking for a bearish pattern within a bullish trend, okay? So we're just looking for that pattern within the trend in order to set our trade up around the pattern, okay? But why options? For one, you're going to have lower margins, especially if you're shorting something. You're going to have lower margins. We talked about this with the synthetic shorts, synthetic longs. Even if you're going long, using synthetic longs is a lot less margin than you would going out there and buying the stock. So it's lower margins. In this case, we're definitely going to be talking about much lower risk. All right. It's going to be defined risk in this case. And if we know we have lower margins, we have lower risk, we have a defined strategy, we know our reward, all of those things, we're going to be able to stay mechanical with this trade. We're going to be able to stay in this a little bit longer than if we were going out there and buying or selling stock against our position, or I shouldn't say against our position, against our putting on a long or short against our assumption. Doing the options will definitely have lower margins and lower risk, especially with this one because it's defined risk. So why options on this? I just kind of mentioned it because on those short calls, you would have been able to be out of that much at a much better location. Again, you're going to be able to wait for different underlyings, even on the top like this, where you get like the topping doesn't quite come up against that other resistance. You might have been able to get involved in a trade around this with volatility, maybe gets short a call spread or something like that up at the top there. Well, it never hit exactly up against that, but you could have seen maybe if you blurred your eyes, well, you know what? It hasn't really been reaching that extreme level from back in 2017. I want to use maybe a fresher resistance line there. So I have no problem with people doing something like that at all. Because my resistance and support might not be as good as yours. I'll be honest, that's might very well be true. All right, so XLU. You guys have heard me talking about this a little bit in the Spot the Trades a couple of times. I even looked at this last week for a market neutral assumption. What we're looking for here, and just like what David was talking about a little bit ago, we've got the point of control quite a bit lower, which would expect a little bit of a correction here. Now, something to note, we've gotten above this Fibonacci. There's actually I got my Fibonacci extension. It's just slightly higher there. But we're trading right around that 68 handle. Point of control is down here, but you can see we're building up a nice big volume node up here where volume's being accepted at higher levels. Now, that's where I was talking about. You start seeing these paradigm shifts in this point of control, prices being accepted at higher levels. Those shorts are going to be a little bit more nervous because they're not going to get that correction that they were probably originally looking for. With that said, breaking above this, I think we're going to settle down here a little bit around this underlying. It's getting a little sloppy. We've had a nice big move. Price is starting to move higher on acceptance of value. I don't think that we're going to continue up here, but I do think we're going to kind of bounce around like that. That's my assumption here with this trade. So I am looking for the underlying to start trading in an area probably right around in between those two lines in the sand, if you will, okay? That's what I'm looking for. So let's talk a little bit about options. If we're going to do options trades, we need to know a little bit about these things, right? Think about this. Let's do some simple concepts again. A call buyer has the right but not the obligation to buy the stock. Meaning if I buy a call option, that means I can at any given time say, hey, you know what? I want that stock. Put it in my account. It will go into your account at the strike level you bought. Okay? You don't get that money back that you paid out for the strike. That gives you the opportunity. All right? You're paying for the opportunity or the right, however you want to look at it, to take possession of this stock. So the call buyer has the right. But think about this. If XYZ is trading at 100 and you buy a call at the 105 level, right? I buy a 105 call. Now I have the right, but not the obligation. I have the right to buy XYZ at 105. Do I want to do that today when it's trading 100? Probably not. I mean, why not just go out there and buy it at 100? I wouldn't want to buy it at 105 when it's trading 100. But let's say I buy this 105 call and all of a sudden this market spikes higher and goes to 195. Well, now there's an immense value in my strike that's 105 when it's trading 195, $90 in value. Do I want to buy it at 105 now? Yes, I would absolutely be considering taking my right to purchase that stock. Now, I have other videos where I say, hey, never do the assignment game. It just costs too much money. You might as well offset the options trade if you really want to get long the stock. If you got out of the options trade, it would have paid you off on that difference, okay? And maybe even a little more. The reason why I don't like to do the assignment game is you're always going to be leaving money on the table. So even though you have that right, it costs a little bit more money these days than get out of the options trade and then going in and buying the stock, because you can buy the stock for free these days, right? So why pay for those assignment fees? Those can ratchet up very quickly. So the call buyer has the right but not the obligation. The seller, on the other hand, because he's collecting that credit, I'm receiving money. I have the obligation to deliver the stock at any given time. Even if it's trading 100, the call buyer could come in there and say, hey, I want to buy this stock at 105. No, never ever had the privilege of having that work in my favor. It never really does. I don't even know that I've ever even heard of anybody getting assigned calls when the strike was higher than where the underlying is trading. That would be a mistake, I'm sure. So the call seller has to do it. He has to go along with the contract, right? The put buyer has the right, I don't know why that clicked off, has the right but not the obligation to sell that stock, right? So if I'm buying a put at 195, or if I'm buying a put at the 95 strike, let's say, because that's below where the underlying is trading, I have the right but not the obligation to sell that stock. Now, I don't want to sell it at 95 when it's trading 100, but if it goes down to 0, I definitely want to sell it at 95 and take that opportunity. But you don't have to. And as a matter of fact, it costs you more money these days to go through that assignment process than anything else. The seller has the obligation to buy it. So if I'm selling puts at that 95 level, I've already accepted that I would be willing to buy it below 100, right? I get to keep the collection of credit though. Even if this goes to 0 and I sold those 95 puts. If I sell the 95 puts, it goes to 0. Yeah, I'm taking delivery at 95. It goes into my portfolio at $95. That's where I am long. I get to keep that credit. If it was like $1.50 or whatever, I get to keep that. So you always get to keep the credit and you never get back your debit. All right, so we talked about these options and the pricing, right? A little bit, buyers, sellers. So we know that there's probably an exchange of price there somewhere. One thing before we even get there, we need to know if those options are expensive or cheap, right? And the only way to do that is to find out what implied volatility is, which is just Vega. All right, Vega is just a fancy word for implied volatility. You won't really see Vega anywhere else other than the option montage, folks. Over in other places, they're going to be talking about implied volatility. Just know you're in the know now, right? Your edge starts with education. Implied volatility is Vega, Vega. All right. So one thing to note, volatility affects further duration options more. You can see the coefficient is much bigger in Vega out here than the nearer duration options. Okay. So the idea is if volatility is low, you want to go back out there in time and buy those, because if those inflate and they have a higher probability, then that's where you're going to make some money, even if you're wrong on directionality and all that stuff. And if you're basically looking at buying, generally speaking, we talk about going to these nearer duration options inside of 35 days to expiration, okay? The butterfly is like the real butterfly in real life. It doesn't conform to what we normally think of happening in life, right? It goes from a caterpillar to a flying insect, all right? So similar to this, you know, usually when we have high implied volatility and things of that nature, I talked about, hey, you know what? That's where we want to sell those options because they're expensive. Well, the butterfly is going to be a little bit of a difference. But I want you guys to know about this implied volatility because it's still important, extremely important to this strategy. If you ever wanted to put on a butterfly, any of these types of butterflies, can you clarify how you buy long put and you pay it a debit when you're selling? Sorry, it's blinking on me. Can you clarify when you buy a long put, you are paying a debit? Yes, when you're buying a long put, you are paying a debit. Anytime you're buying that put, you are basically saying that I think this underlying is going to go down, right? So you're buying protection. You can think of a put as downside protection. Now, if you're selling a put, think of it as if you're selling an option, that's either where you want to get in or out of an underlying. So if I'm selling a put, that's where I want to sell that put. I collect a credit for it, but I'm also looking at that strike and saying, hey, you know what? I'd be willing to get long this underlying there, right? Because the put seller has the obligation to buy it, right? But you get to keep that credit. Now, a call seller, if you're doing like a covered call, you're just basically saying, I'm willing to sell my stock here. I don't care. Does that make sense? When you buy a long put, you want it to go down. Okay. So implied volatility affects the further duration options more. And when volatility is at highs, that's where we know those prices are most expensive, right? And when volatility is at extreme low levels, then we know that the pricing in the options is really cheap. So we're looking at XLU. And I'm going to look at I like to look at the 35 days to expiration. That's what we call the spot month, folks, on the floor anyway. So the spot month is just usually where the most volume is or the most eyeballs, okay? That's where most people are watching. So that's going to probably have the best markets. It's also going to give you the best indication of what volatility really is. All right, so we've got volatility at 17. Anybody know if that's high or low? Oh, you're raising that point for some newcomers. I appreciate that. Did I explain that well enough, you think? So the 17, is that high or low? Well, we don't really know because I've never seen Tesla get as low as 17, ever. All right, so for Tesla, this would be low, but 17 for XLU could be extremely high. So what we need to do is compare apples to apples, right? I can't compare implied volatility of Tesla to implied volatility of an ETF, right? It just doesn't work that well, especially when I'm looking at a utility ETF. Utilities usually have much lower volume coefficients. All right, so I need to go over to the charts here. And here you'll see I have a chart of implied volatility down at the bottom, all right? And the reason why I do that is because I need to know where that number 17 is, right here, that dot today is in relation to the high and the low. Because just like swing trades with stocks, our swing trade is with implied volatility. As a matter of fact, I would say lean towards swing trading the implied volatility more so than even the underlying. Look for that implied volatility as the determining factor of what your strategy is. So I want to know where this dot is in relation to that high and low of this underlying. Because here, I'll show you. We can pop up Tesla probably pretty quick, and you will see that Tesla, this is XLU at the end of the day. Let's just take a look at Tesla real quick, and you'll see that it is at its 52-week low right now, Tesla, and that's 45. As a matter of fact, 45 is extremely low for Tesla anytime. But as you can see, when we're looking at our example of XLU, has it even gotten to 45? No. So again, Tesla's low isn't even as low as XLU's high. So that's an example of why we want to compare apples to apples. So we need to find, I like to strip out basically last year, folks. I want to get rid of that data because I don't think we're going to really see that kind of extreme levels. Even if this Delta variant flips around, guys, and they start doing close downs again, I don't think we're probably going to see this volatility spike to the extreme levels we saw during the pandemic, okay? Because we still have a pretty good idea as to what's going on now. So what we need to do, if you guys really want to dig into it, I've got a formula for you. But the other thing is the ballpark. Take out some of the black swan event that happened last year and take this year's data points, all right? And try and draw in your support and resistance. And you can see we're right there at the mid-mark. So it's kind of a pick-em where it's going to go up or down. I think it's probably going to continue to come out here because I don't think XLU is going to do anything for the anytime soon. So we could say that the high, drawing this across, we're going to say that's 27 coming across here. I'm going to say that this is going to be around 6, 0.06 really. And then right now we got 17, right? So you take the current implied volatility subtracted by the low. So ultimately what we're trying to do is find out where the current implied or where the current is off that low in relation to the entire range. So then we want to divide that by the sum of the high IV minus the low IV. All right. So the current we said is 17. Let's just round it. 17 minus the low is 6. Take that sum and divide it by the high. 27 minus the low is the range is 6. So what do we have? 11 divided by 21. So that's going to equal somewhere around 52%, 52.3%. Okay. So sell zone, because we've got that extreme volatility, that means our prices are at extreme levels, right? And the buy zone, if you want to make it simple, right? And it's kind of a pick 'em right there at the middle, right? You're going to need to kind of come up with something if you're trying to put a trade around this, all right? Most times I'd say kind of stay away from it, but I think the volatility is going to continue to come out because my overall thesis is that we're going to kind of trend pretty much sideways for the foreseeable future here, all right? So it's above that 50 line. It's a sell zone. I would say they're expensive, right? So when they're expensive, oh, sorry, what happened there? Why did my thing not come out? It's not working for me. Anyway, they're expensive. I was supposed to have a action happen there and it's not. So we can see they're expensive because it's above that 50 line, right? We came in at 52%. Because volatility is about 50% on XLU, you buy the butterfly. Otherwise, you sell it if volatility. Well, so the butterfly, when volatility, this is why it's different, right? When volatility is high, we usually say you want to sell options, which means it comes out with a short call spread, a short put spread, or whatever, right? Well, and when they're cheap, we say you want to buy options, which means that you go in there and you're going long the option. We have expensive here, but we also are looking at a call butterfly. So the call butterfly and the put butterfly, which we'll talk about next week, they're a bit of a different beast here. When you're looking at if they're expensive or if they're cheap, when buying an option, we say you want to limit that theta decay, but we're talking about now this butterfly, right? We've got a butterfly now that's going to change all of this stuff. And when they're expensive, we think that, hey, when they're expensive, we want to sell options. Well, with the butterfly, when they're expensive, we do the long call butterfly. And I'll show you why here in a moment. But just know that when we're buying with this strategy, or when we're talking about the butterfly, usually we're buying with low volatility, selling with high volatility. Well, this one, we are going to end up doing this for a debit. That's why it's the long call butterfly. But I'll show you why the levers and pulleys want to make this work out in our favor or change a little bit. We still want to, with the butterfly, take advantage of the thief in the night that comes and steals our premiums. We've talked about this. This is your buy zone, right? This is your sell zone, right? Inside of 35 days to expiration, because this is what happens to our premiums. And out here, we retain premiums. So usually buy zones out there, sell zones in here. Well, we've got the butterfly again. We've got this butterfly that's going to screw everything up, all right? And it's because it doesn't conform to the rules of nature. It's breaking those rules. So with the butterfly, we are actually going to be going in to as close to 35 days to expiration as we can with the long call butterfly, all right? It breaks the rules. If you don't walk away from anything else with this strategy, just know that the butterfly breaks the rules. So we showed you on that example how how theta increases the closer we get to expiration. Well, here's another way to look at it. We're looking at theta on the calls, and we got the puts over here. We can still see theta and the coefficients that go with it. Well, out here, 150 days, you can see theta is only coming out at about 6 cents a night. Well, you fast forward about 70 days and it's 7 cents a night. Fast forward another 30 some days and it's increased now another penny. So you can see over the course of basically 7 days and only in 70 days, it increased only about a penny. And then we're getting a little bit closer. It's 30 days now increases a penny. Now we go from 58 days to 23 days. So another 35 days, right? So in this 35 days though, look, it has increased by 50%. It's gone from 8 cents to 12 cents, all right? It's increased by 4 cents versus way out here, theta is not really hurting, okay? So usually when we're talking about it, we want that theta to be on our side. In this case, we want theta to be on our side as well. And I'll show you why. Because we're going to be looking at this underlying, this is ours, and we can see this one, it's still going to have the theta start to ramp up the closer we get to expiration. But remember when I was talking about volatility affects further duration options more? Well, theta affects the nearer durations options more. And the at the money. So volatility will also affect the at the monies more so than the further in the money or out of the monies as well. Okay, you can see Vega further out of the money in the puts, further in the money in the puts, the at the monies, right? In the monies and out of the monies not being affected nearly as much as the at the monies on the calls and in the puts. We can look at it right. That's the delta. So the volatility, excuse me. You can see the volatility affects further duration options, theta, and the at the monies as well. All right. So the at the monies are really going to be affected more dramatically by theta and vega. All right. And gamma and basically all of them. So when we're looking at this, just a little bit of a recap, we got high volatility, but I know that I want to stick to this call side. The reason why we would want to lean towards a call butterfly, a long call butterfly, or a long put butterfly, okay, versus what we did with the iron butterfly and the iron condor, all right? This strategy is very, very similar to the iron butterfly. Now, if you remember though, on the iron butterfly, we did a short call spread and a short put spread at the same strike. Now we're flipping all to one side of the option montage to the call side. Now, I wasn't able to find a great example of skew, but usually when the calls are more expensive than the puts, that's when I'm going to move away from an iron butterfly and into a call spread. And when I'm talking about skew, what we're talking about is that the calls are pumped up a little bit more. Now you can see that this one is like a 68. It's out of the money, but it's a 50 delta, whereas this is slightly in the money and it's still a 50 delta, right? It's only 11 cents in the money. So there is a little bit of skew to the call side, all right? Equal distance away, those premiums should be equal, but they aren't necessarily. They're off by about a nickel, to be honest. So there's a little bit of call skew here. Now, you will see, especially in these meme stocks, the call skew is massive, where, you know, you might have this call out here that's way out of the money being a 50 delta, okay? So that means it's a 50-50 chance that that strike will be in the money. Well, it's a long way away from there at this point. So that means the skew is going to the call side. That's when I would break away from doing an iron butterfly and going to the long call butterfly, okay? When the skew is really to the call side is the best time to do that. This has a slight skew. It was the best skew I could find on a day basis here. So with this, I'm going to, because there's call skew, I'm going to lean towards the long call butterfly, all right? So with that said, the long call butterfly, we're going to be using options that are basically selling the at the monies, okay, around that 50 delta. So we're going to be thinking the underlying is going to be trading and not really move anywhere. Zero means it hasn't gone up or down, okay? And then down to the put side, we're going to try and define this right around this one standard deviation move to the downside. If we see this is negative, puts negative, calls positive, and one standard deviation to the upside. So what we're trying to get happen is 70% chance of all of this, 16% chance of it blowing through the top, and a 16% chance of it blowing through the bottom, okay? So we got a 70% chance of it staying right in and around here. Now, I talked about this in the last video. When we're looking at the Analyze tab on this, it's going to look kind of like the iron butterfly, where it looks like this, and basically there's your line in the sand there. But that's normal distribution, right? And just like the standard deviation curve that I showed last week, if volatility is really high, then if this is normal, we could see that our Analyze tab would then look like this, all right? Same thing where the underlying's trading right here, but this has high volatility. So my strikes will be further away on the puts, right, than in the calls. Now, it might still be the same delta, but volatility means that the probabilities of a wider move are going to happen, okay? And I'm expecting a narrower move to happen. So what I want is that volatility to come out, and my Analyze tab goes from basically like this to like that. And that's what will happen when that volatility snaps out. It'll come in a little bit. So make sure that you're doing this strategy around high volatility for the long call butterfly, because the long call butterfly doesn't conform. All right. So what does delta tell? One thing I forgot to mention over here is standard deviation. All of these probabilities are equivalent to deltas. All right. So a 16 delta is equivalent to a 16% probability. All right, of being in the money at expiration. All right. Not during the life of it. All right. During the life of it, it can come up and hit there, and the probabilities of that happening are twice as much as the probability of being in the money at expiration. All right. So you will maybe get tested, but just know the probabilities of it ending there are very low. All right, so delta, usually people will say delta is the rate of change to an option, meaning if the underlying goes up by $1, then my premiums go up by that corresponding delta, right? We're just talking about a 50 delta. That means if the strike is a 50 delta, then when the underlying moves higher by $1, my calls will increase by 50 cents, all right? If the delta is negative, which it is on the put side, if the underlying moves higher by $1, my premiums go down by 50 cents because the Greeks all assume that we're moving forward, okay? We're advancing. Delta assumes $1 higher. Vega assumes 1% higher in volatility. Theta assumes we move forward a day, okay? None of those are assuming we move back. If there is a skew towards the call side, you will not do the iron butterfly, rather do a long call butterfly. What's the rationale? The higher premium? Yes, the higher premium on those calls getting skewed. So on the iron butterfly, basically I'm selling the at the money strikes. Well, the at the money strikes, if my call skew is that massive, where maybe 5 ticks out of the money is my 50 delta, well, then I'm going to be basically playing around with a delta that's about 70 on the calls and maybe 30 on the puts, right? And they're still at the money. So then when I'm defining the risk on that butterfly, it gets a little wanky because of the skew. So in this case, if there's really great skew, like to the call side, I would shift over to the call side and my butterfly is going to look really good because it's going to have really wide wings. I'd rather have these wings really wide because then I'm collecting a nice big premium. That increases the amount of movement my underlying can have, right? Up or down. All right. So with the long call butterfly, ultimately what we're trying to do is add a couple of call spreads together, right? We're doing a long call spread. We add a long call spread to a short call spread and kind of jam those basically together. And our strikes are the same. These two strikes are same strikes. All right. We're doing 2 of those, if you will. All right. And then this is a guesstimation on the 80 delta. Ultimately you'd probably like it at around an 84 delta and a 16 delta, right? That's usually where it kind of lands out. But ballpark figure when you're doing this, you want to look at these at the monies and then go find your wings there. So a couple of rules of thumb here. $5 wide, you're going to basically be $5 wide. $5 wide, you're going to be $5 wide, folks. On a $50 stock, you're going to be about $5 wide. On a $100 stock, you're going to be about $10 wide. Another thing to look at is when I sell this at the money call, look at it like, all right, so I sold 2 of them. If I collected $1.50 there, it looks like $1.50. It's really $3, right? Because I did 2 of them. So that's where you're going to look at $3 wide then. If I collect $5, then I'm going to go look to $5 wide. All right. If I collect $10, I'm going to go to look to $10 wide. That's an easy way to kind of start narrowing this down so you're not punching it in and out all the time. It'll be a little bit easier. So, for instance, here, I'll just try and see what we got going on here. This is something different. I hope I don't screw this up. I probably am. So I want to look at doing these at the monies because that's the 50 delta or as close to it as we can. So I want to hit 1, hold down control. So right now it's saying it's $3 wide, but I think that's because the markets are really wide. $1. I'm going to go with $3 wide because really mid-market's going to be much better than that. So $3 wide, buy the 65s and the 61. So basically right here, I'm paying a debit $1. I want to collect 1/3 the width of the spread. So that's right in line with my rules for this underlying. Collecting 1/3 the width of the spread, or not collecting, paying 1/3 the width of the spread. All right. So the reason why this ends up being a debit, we want high volatility because The ones we're selling are these at the monies, right? I just got done telling you guys that the at the monies are the ones that are going to be affected by this volatility the most and the theta the most. Now that's a little wanky. It should be 2 cents probably. But these at the monies, you can see the volatility is going to affect those more. So if volatility comes out, right? If volatility comes out, I already believe I have high volatility and I think that volatility is coming out. Well, if that volatility comes out, it's going to affect the at the monies more than the out of the monies or deep in the monies. So these options, that's why it's not working. These options are going to get the most vega and the most theta, all right? So I'm selling those. If volatility comes out, those are going to decrease the fastest, all right? So that's why with this strategy, despite the fact that it's long, because I'm buying this really expensive in the money option to define my risk, right? But this in the money option is expensive because it has value. Remember when I gave that example earlier on and I was saying if you buy a 105 call above where the underlying is trading right here, do you want to, take that stock at 105? Do you want to buy it at 105 right now? No, because you can buy it at 100. All right. So similar to this, when those options go in the money, and then I said, remember what I said, I bought that 105 call and now the underlying is trading 195. There's immense value in that because it's trading from 105 to 195. There's $90 of value in there. So options that are in the money have got to have intrinsic value. I mean, they have to reflect where the strike price is to where the underlying is trading. So in my example, when we were talking about the 105 calls and it's trading 195, that 105 call, immediately I know that 105 call is at least worth $90 because it's trading 195 and my strike is 105. That's $90 of value. It has to at least be worth that no matter what, all right? It's the benefit of owning that. So in the money calls always have to include the benefit or the intrinsic value of that option from where it's at now. Like these 65 calls have to at least have $3.11 in them or $3.20 in them, right? Because right now it's trading 68.20. These calls are in the money. I could buy it at 65. Well, this value from 65 to 68, it has to be $3.20. We can see that it is worth a little bit more than that. Don't look at that bid. There's at least, I'm 320 bid. So the market's reflecting the intrinsic value of it. So if this underlying stays right here, we get volatility and theta and all those things happening. Well, this at the money option, we just talked about it. It's 60, or my strike is 68. I have 11 cents of intrinsic value. That's really all it's worth, 11 cents, folks. But I'm somewhere in there at around $1.40 or something, right? That's what it's costing me. So that means there's about $1.20, $1.30 in extrinsic value. Those are the ones I sold. So these ones I sold right now have the best opportunity to lose the most amount of money, right? These right here at 65, if you look across, that gives you on in the money option, gives you a pretty good ballpark as to what the extrinsic value of it or that theta decay happens. So 32, so I'm buying that. I could lose 32 cents there on that part of the strategy, and I can lose 22 cents on that part, on those 71 strikes. Those are the ones I bought. I'm assuming the 65s are going to retain their value and that these 68s are going to lose all their value. So the reason why it gets switched a little bit here, I make money on those at the money short calls. That's what I'm banking on. Volatility coming out, theta helping me to make those at the money calls just dwindle to nothing. I'm hoping that my underlying stays right here so my 65 calls retain the intrinsic value, the value that the benefit gives me of owning those, being where the in the money call is to where the underlying is trading. That's $3.20 we determined. All right. So I'm assuming that those in the monies are going to retain the value. The at the monies are going to lose the most value. And my out of the money calls are just there to define my risk, because I would be naked short a call then. So I'm just trying to define that risk to the upside. So if we bang this out, we can see that we got this debit of $1.30. That's best case scenario. Collecting a third, or sorry, paying a third the width of the strike. That means it's a $3 wide. I pay a debit of $1. That means my max profit is $2, right? Because I can collect all of that. Max profit is $2 then. So this is how we would set it up for $1.03. Where do you get out? Well, in this strategy, for me, it's going to be a pretty defined risk strategy. So I'm going to probably ride this one out for you folks. I'm going to let this one ride, because anytime I get that defined risk strategy, I'm more likely to let it ride out. Now you can see here during the open market operations, I did an example. They were the same strikes. It was before the end of the close. I was getting that 50 exact delta there before the close. And the debit was $1.20. Now I said you want to collect a third the width of the, or sorry, pay a third the width of the spread. All right. No more than 50% the width of the spread. So basically my debit is a third to a half the width. All right. Do not go more than that. It's not worth the risk reward. Third the width is best case scenario. But you might have to go close to a half. I'd say, like 40% would be about as much as I would go. Otherwise, I would be starting to look at the butterfly again. No, sorry, the iron butterfly. All right, where do we get out? Well, if you are looking at it from the chart pattern on this, I would say, so right here, we're looking at this 68 strike. So 68 here, 71 is above this fib. That's why I wanted to draw that down there. And then the 65 is right here. So you can see I've got nice levels there. That's why I'm, especially with this strategy, going to look to stay in it. Because if it breaks above here, I'm already going to be looking at max loss there. And if it breaks below this fib, I've already looked at max loss. So with this strategy, and the butterfly, folks, does take a long time to really work itself out, unless I really get this volatility to just slam down immediately. It does take a little while for this strategy to work itself out, because the nature of the selling, the at the monies, and then we have that defined risk strategy on it. But you can see I've got good strike location on this. I'm expecting it to kind of settle down here. I already talked about it. So as long as it stays within this area at settlement, that's perfect. And I've got great strike location because I've got a nice resistance band above me that is slightly inside of where my max loss would be. So we could come up there, bounce that, test it, or even come down and test my extreme low, bounce off. But this one, because it's defined risk, it's going to take a long time to work itself out to get that nice credit. You're going to probably need to stay in this a little bit longer and be a little bit more hands-off, if you will, because it's very difficult to manage this one. It's kind of like a put it on and let it ride type of trade. And we can look at the Analyze tab here on this trade. It looks exactly like the butterfly or the iron butterfly. Remember, we did this last week. Define risk strategy. Last week, we were trying to get to risk one. Right now, we're risking one to get two. Okay, because the debit, we're trying to take a risk the dollar to make the $2, max profit being $2. Well, this one's the same way, right? I'm risking the dollar to make the $2 on the other end. And that's why I was trying to get my platform. I wanted to show you guys that same setup today with the analyze tab. Hopefully I didn't lose that. It did. It switched off. So let's just go back real quick and do this quickly as if it were going to be the butterfly here. So boom, we sell the 2 at the monies, and then we're in the 36 days because we want that theta decay. Go to the 65 puts to buy them and the 71 calls to define that side, right? Now look at this. I'm collecting $1.82 on a $3 wide. My max profit on this is $1.80. My risk is $1, or the loss is $1.20. It's the same thing as in the other one, right? As a matter of fact, if I pull this up this way, I can even show you even the outlay of cash. So if I do, actually, let's just go confirm. $118 buying power effect on this strategy. That's why we want to look for the skew on this one to determine it. That's going to really be what pushes us. I don't know why I did that. Wait, come on, gamma. So if the skew is to the calls, we do the butterfly, the long call butterfly. If the skew is to the puts, we would do the long put butterfly. If the skew is normal, then we do the iron butterfly, okay? So we saw the iron butterfly here. Now if we do this one, I'm selling 2 at the monies, buying the same strikes, it's still those same 65s, and selling, or sorry, defining the risk by buying the 71s. So right there, and we showed you it was $1.20 during the open market. So it's right around that same area where I'm paying $1.20. That's my risk. My reward is that $1.80 on these $3 wides. Okay. And the only reason why I'm not doing the iron butterfly on this one is because of the skew to the call side. Okay. So when you get those big skews, especially in these meme stocks, you know, you get them a lot. This is where you should be leaning towards them. Okay. Whenever you see that the calls are really out of whack. Usually you see skew to the put side, not the calls. You can think of the skew as FOMO. All right. If the skew is to the puts, people are thinking I'm worried about the downside, fear of missing out of downside move, right? Because they're buying puts. FOMO to the skew to the call side is I fear of missing out of the upside. So I'm buying calls and jamming up that volatility. So this is that example that we looked at for today on this butterfly. And you can look at it on the Analyze tab. It looks basically the same as what we're looking at on this chart. And then this was the other example, the 2. And I showed you the Analyze tab looks just the same. If the market moves too high or too low, then that's going to work that out. I cannot see the screen well. 720 put maximum, no HD option. Eric's not clear, very hazy. Is everybody getting the hazy? Is this screen just, you can't see these numbers very well? Because it looks clear to me. That's why I don't understand. Is it too small? Or is it hazy? Because to me, it doesn't look blurry. A bit unclear. All right, I'm going to have to go back and look at it to see, because to me, it looks really clear. All right. I don't know. I can't fix it, right? I can't fix it on the fly. I'll start making these blown up a little bit more is all I can think of. It's trying to stretch it out a little bit. So it's a little bit, resolution is low, 720 max. Oh, yeah. All right. Thank you. I'll try and work. Blurry is a better word. All right. I'll try and work on the resolution, on fixing that resolution for you folks. That's probably the problem. I'll have to do that in my settings because my screen right now, the way I'm looking at it is right. So it must be the way it's converting and kicking out to you guys. Sorry. Try 1080 next meeting. We'll do that, Oli. We'll try that out. Olina, right? Appreciate it. All right, good enough. Well, I'm sure you guys will be able to read this one, though, because this is our offer for you folks today. Doesn't want to slide. Guess we'll just have to go that way. Here we go. Guys, this is our course, Trade Like Wolfman. I do all kinds of stuff in here, how to set up a market profile. David was talking about that, the point of control, all of those things, how to trade in and around that, when, where, and why we can find different option strategies, why we're using those specific option strategies for that assumption. All right. It's not always just going out and buying calls, folks. And you're getting well over 15 hours of content for 36 bucks. If I can save you guys setting up a trade wrong where you were thinking, hey, I got a bullish assumption, I'm just going to go buy a call like some of these meme stock traders are doing. Well, that's all fine and dandy if you get that move. But if you don't and the volatility comes out, you actually might even get a bullish move, but that volatility coming out hurts, right? So stay away from those types of pitfalls. And you can do that. I'll throw the link over here in this chat window. Hopefully I got that there. Nope. I'm going to have to go back and find it. But here is the link again for the computer. There we go. I'm going to throw it over in the chat window for you. It's taking a second. All right. Work with me, computer. There we go. Here's your link for you guys. It's the same link that is on the window there. For 36 bucks, though, you get the discount watching this. So make sure you hit that link there rather than any other links you might see out in the Twitter sphere or anywhere else. John, I see, John David, I see you. I'll get you real quick. Let me hit one more screen here. This is also the page that will take you to when it's hit in the URL. Just hit the click, add to the cart, and you will get all of this stuff. Folks, it's not for a limited time on this. Like, you will have the time to go through that. And as a matter of fact, it's actually like a little box, and it checks it off for you once you've watched that. So you know what you've seen. You don't have to mess around with it. So if you guys have any questions, comments, or anything else, please reach out to us at Trading at Pro Trader Strategies. You can also reach us at 310-598-6677. Again, here is a link, but much easier to click on the link over there in the chat window because that is going to be a hot link for you folks. All right. That's about it. I see David's got a question real quick, and I'm going to try and answer that before we go, but I'll leave this up for you folks. Oleana, do you have any trading on how to trade long calls or long puts? Absolutely, Olena. You can reach out to us. You don't want to necessarily click on this link, or you can go on that link and kind of flip through there. There's other offers in there, but the best way to follow through with that is to reach out to us at Trading at Pro Trader Strategies. They'll be able to show you exactly what you're looking for. Okay. And David, quick question: is the iron butterfly? Oh, the iron butterfly is used if the skew is on the put side. No, what I was trying to say is the long put butterfly is what we would use if there was massive skew to the put side. The long call butterfly, if there's skew to the call side, and the iron butterfly, if there isn't really a whole lot of skew. Like with this one could probably say, hey, Wolfman, you're talking about a nickel of skew. That's not really skew. And they would arguably be right. Okay. I just wanted to try and give you guys that example of the skew. You will see skew happen even more than that, where, you could see that the underlying is trading 68. Okay. Where our example was, we're trading 68 right here. All right. And we've got the 67 call. Let's say the underlying is trading 68 exactly. Okay. XYZ is trading 68 exactly. So we've got these at the money calls, the calls that are slightly in the money and the ones that are out, right? So what I was saying here is, say 69. So, and we're trading right here. The calls might, let's just say, are $1.50, and the puts for these same strikes are $1.20. Okay. And it's trading 68 even, which is exactly right on the money of that call. This is how you would be able to tell that there's calls. The puts are trading $1.20 and the calls are trading $1.50. That's what we're talking about, like that skew. Okay. It's not always exactly right there. You would sometimes it might be trading 68.50. So then you're going to kind of try and skip a little bit further there. Okay. Usually the skew is to the put side. If the skew is to the put side, we're doing the long put butterfly. Skews to the call side, long call butterfly. No skew, iron butterfly. All right. All right, folks. I want to thank you guys all. That's about it. Make sure before you go, click that subscribe button right down there at the bottom. There's a little bell because that'll give you a notification when I come in unannounced, that you'll be able to, when I'm talking about a trade. Sometimes throughout the day, all of a sudden, hey, I found an opportunity for a trade. I, in the past, would wait till the next day to tell you guys about it. Now I'm coming on and I'm going to be doing it live. Like we could even be setting up the trade live during that because I want to make sure you guys are a part of that. So check that out with that bell. You'll get that notification. Comment over the side, even if it's not live. I'll circle back around for you folks. Make sure everybody's clear concept, just like I did during the live video here. We are doing these live, so if you were waiting for notifications from Pro Trader Strategies, you might be out of luck or you'll be getting this sent to you delayed. I'd love you guys to be a part of this live because you guys drive the content. You guys make this more interesting for me and you. And likely somebody else out there has that same question you have and just isn't kicking it to the window. So last thing I got is take that. All right. If you can't take that, take it easy. Bye for now. Thank you, Olian. Appreciate all the kind words. Bye for now.